Good afternoon and welcome to Market Mondays. Now, as a recap, US markets fell on Friday, weighed down by losses in the technology sector and a rise in US Treasury yields after the summit between US and China left traders worried that there were no major policy breakthroughs. But as the Wall Street Journal puts it, no news sometimes can be good news because the main rule of presidential summits, like the one we just had, is first do no harm. Now, more importantly, also, at least on the surface, neither the US nor China appeared to give away anything to their country's detriment. Now, for Singapore investors, the more important question is whether safe haven flows will continue and that the AI thematic stays relevant. So let me first invite our first speaker, Chua Hak Bin, our co-head of macro research, to address this first point. Hak Bin and his team recently did research on money flows from wealthy Asians and where they are landing in Asia. But before I invite Hak Bin onto the program, I'd like to request the audience to pin the video tiles that you see on Zoom, which would make it easier for you to view the speakers and the slideshow at the same time, especially if you're using a mobile phone to view this program. You can basically access the pin feature by locating the three dots inside the video pane of the video tiles and click the pin feature. So back to the program now. Hak Bin, as always, great welcome to the show. I'd like to first direct the first question to you. And basically, based on your latest research, what are the signs that the wealthy are using Singapore as a safe haven for their investments? Hak Bin?
Hey, hi, morning, Signal. So back in March, when the war broke out, there were all these reports, anecdotal, reports that wealthy Asians were starting to move their money from Dubai to Singapore, and maybe to the less extent, perhaps Hong Kong. And then I guess now we have the first full month of data for March to whether that was happening, and I think it seems to confirm those impressions. Five particular stats kind of show that. One is the sharp jump in Singapore deposits. Singapore deposits went up by about 18 billion in the month of March. Second is the foreign currency deposits, which went up even more. I presume this could be the private banking flows as well. That went up by about 48 billion. And then third is also the MAS foreign reserves, which rose in March, but also April. The April numbers were a bit lower than March. Maybe the second month of the war, the safe haven flows kind of moderated. And then fourth is actually the deposits by non-residents, which the MES provides that breakdown. That went up by 33 over billion. Unfortunately, MES doesn't give a breakdown of the nationalities and where the money comes from. But the fact that it coincides, I presume quite a bit probably came from Dubai or the Gulf regions. I think the fifth is also quite glaring, which is the gold imports from UAE that jumped to a 5-year high. Staggering numbers. And again, that one is confirming that it is coming from Dubai. So I think all this is increasing liquidity in the financial system and also pushing down interest rates.
Okay. Well, these 5 points are clearly working in favor for Singapore investors and the market. But over the medium term, do you think these flows are durable, or what factors might actually put these positive tailwinds at risk?
Yeah, that's a good question, Senghor. I guess to me, part of it, I mean, we'll see whether it's hot money or whether it's going to be sticky. But I think the sense that probably investors and wealthy individuals will be reassessing how safe Dubai is in the longer term. And given the current situation, it's hard to believe that Dubai will not suffer some kind of collateral damage, in the medium term. It is very close to Iran. It is we noticed that a number of missiles and drones among the Gulf nations. Actually, Dubai got hit the hardest, right? Apparently, the relationship with Israel is the closest, among the Gulf nations, UAE and Bahrain. So I think that puts it in a very kind of a fragile kind of position, which I think seems to be benefiting Singapore to some extent. We did also check whether the flows were going to Hong Kong, and there's less evidence of that. So materially, Singapore seems to be benefiting from it. Of course, never say Singapore cannot be hard hit if there's a uncertainty in the region that develops, if Singapore's reputation is as a safe haven is undermined in any way, that could always shift to an outflow of funds. But currently, I think I might sense that it's probably going to be quite sticky.
Okay, all right. So let me just take the next question, which is on Singapore's credit market. What are the implications on the Sing dollar interest rates based on these developments right now?
So I think the good news is that if there are safe haven flows, then actually that keeps the banking system quite liquid, high growth of deposits, and probably which depresses the interest rates. And we saw some of that happening in March and April when interest rates, remember, were rising in many other countries. I think the 3 month SORA is still low, 1.07%. Some of the auctions and treasury bill in the months after the Gulf War actually showed higher applications and a higher bid to cover ratios. I think most telling is the 10-year bond yield, where the 10-year Sing actually spiked up, almost 40 odd bips alongside the US bond yields. But interestingly enough, in the last 3 weeks, the Sing 10-year has come on to
Mm,
almost pre-Gulf War levels, whereas the US rates are, of course, testing new highs with the inflation fears.
mm.
So yeah, it's probably good news in terms of interest rates.
Okay, all right. So it does also sound like on SORA rates as well as for the Sing dollar treasuries that, we may have perhaps seen almost a peak at this point in time based on the interest rate environment that you just described.
Sorry, can you repeat that? I missed that question. Sorry. Yeah.
Yes, in terms of Singapore bonds, that
Yep.
possibly, we may have seen a peak at this moment
Mm.
based on the interest rate environment that you just described.
I mean, it does look like the 10-year bond yield in Singapore peaked at about 2.41% on 27 March, and since then it's dropped to about 2.1%. So I guess whether we will reverse test those highs will depend also on the behavior of the Fed, as well as whether on the US side inflation fears which there are high chances of it going above 5%, whether that will lead to a run up as well as US bond yields. But for now it looks like Singapore long-term bond yields probably going to be fairly well behaved.
Okay. Well, my last question is this. Based on your data, are foreign fund flows stronger or weaker into equities compared to bonds then?
So we took a closer look at the fund flows, since second half last year, since the EDB program started, and also this year, and the sense is that the fund flow into equity markets have been going up since the middle of last year. I think, coincidentally or not, along with timing, since about May last year with the EDP program. Whereas the bond outflows since the fourth quarter of last year have kind of accelerated. So bonds, money's leaving Singapore. I suppose the yields are pretty low, but equity flows have been coming in. In terms of the magnitude, since the start of this year, foreign equity inflows into the Singapore's equities is about 1.8 billion, whereas bond outflow is about minus 1 billion, relatively. So looks pretty promising, and that's, I think, supporting the Singapore equity market as well.
Okay, excellent. That's a nice segue to my next speaker. Thank you so much for your insights, Hakbin. Uh,
Thanks,
we're
Sunil.
next, we're next going to invite Husseini onto the call. Husseini is our utilities as well as data center analyst, and he also covers Sea Limited. Now, Sea Limited's profit beat last week gave its share price a phenomenal boost, and this was basically the strongest boost over the 9 months to date. Husseini, hi, welcome to the show. Please walk us through your observations for Sea's businesses, Shopee, Garena, and last but not least, its fintech arm, Money.
Sure. Thanks, Yao, for having me. So yeah, means it was one of the rare quarter where all the three engines of C's businesses delivered very strong results, fired on all the cylinders, which is Shopee, Money, and Garena, the gaming business. So maybe starting with Shopee, Shopee delivered 30%, 30% GMV growth, taking its GMV to $37 billion, and the revenues as well grew at 45% year-on-year rate, which kind of highlights the company's ability to monetize its ad revenues as well as other value-added services. Now, so it was a very strong delivery on the Shopee side, although the margins came down a little bit. But it was on very expected lines as the company is investing more and more into logistics and fulfillment infrastructure. So the margins dip was not because of the competitive pressure, it was more of a proactive investment. Now, moving on to Garena, which is a gaming business, that was also a phenomenal result, wherein the bookings grew by around 20% to zero. And note that it was one of the best quarter in the last 5 years in terms of growth. Now, means what is driving the Garina's business is because for their the key Free Fire game, they had various collaborations as well as the monetization was high in a seasonally first quarter. And finally, not means last but not the least is the money business, the fintech business. Now, this is one of the very hidden gem in the company's portfolio, wherein the EBITDA for this business is around 275 million for the quarter, which is kind of indicates that it's a 1 billion EBITDA business on its own. And what is important is that it is the business which is not just tied to the e-commerce arm. So it's not just a buy now pay later, but it is evolving as a standalone fintech business catering to cash loans or off Shopee buy now pay later, which is important because that kind of underlines that it is growing as a or evolving as a standalone business. Now, one thing to note is that for this business, the margins came off in the first quarter, but again it was on the expected lines as the bigger growth comes from markets like Thailand and Malaysia, where the interest yields are lower. So net, it was a phenomenal quarter with company firing on all the three cylinders.
Okay, great, fantastic. Now, Husseini, CCO is betting that AI can underpin its next phase of growth. And he has even sent out an internal note to employees that if the strategy is done right, C could be a 1 trillion USD market cap company if all things pan out. Please tell us if this is realistic in this competitive landscape.
So the interesting thing is that Forest Lee's USD 1 billion aspiration, market cap aspiration, was communicated when AI was not seen as a threat for the sector. Okay, so since then, the stock has come off almost 40 to 50% because the rather than AI seen as an opportunity, investors are seeing AI more of a threat to the business.
Yeah.
So in e-commerce, the fear is that AI agents and chatbots could eventually become the primary interface. And the risk is that investors see this as a risk that Shopee could eventually become a logistics and fulfillment utility, while the interface will be owned by AI agents as well as chatbots. So that is seen as a big risk. The
Okay.
other risk is that on the gaming side, AI can democratize game developments, and that in turn can bring in more and more competition for the likes of Garina. So those are seen as a risk, and as a result, the stock has corrected almost 40 to 50% in the last, say, 9-10 months. So net, yes, AI is an opportunity, but it's comes with a big condition. It's a big if, and before that, we are of the view that company has to get its AI strategy, the disintermediation risk strategy right. Now, that said, as the stock has corrected 40 to 50% since then, in our view, most of the risks are already priced in. In our view, the stock is trading at its bear case risk, and given the correction, we are of the view that it's a good time to accumulate. So net, whether it can go to 1 trillion or not, I'm of the view that it's a very aspirational, but we do see a meaningful upside from these levels.
Fair point, Husseini. Husseini, before we let you go, could you just comment on your fair value target for this stock and what that valuation is pegged against?
Yeah, so our fair value is 128 dollars. Stock is trading at around $88, so there is a meaningful upside. It's pegged on a combination of DCF as well as relative valuation. So for relative valuations on the e-commerce side, we look at the likes of Mercado Libre in Brazil, which is a very close competitor. For gaming business, the key competitor or the key peer is Krafton in Korea, and for the Garina, for the money business or the fintech business, we have a slew of peers like Affirm and Klarna, which are the US trading companies, trading fintech companies. It's essentially an SOTP, and within SOTP, the key businesses are valued using a combination of relative as well as DCF model.
Okay, great. Thanks so much for those insights, Husseini. Now we're going to turn to our next speaker right now. Eric is overseeing the airlines sector, and one of the stocks under his team's coverage is SIA. Now, SIA reported at the high level, a stellar set of results for its core operating business. But this afternoon, we'd like to talk to Eric about his thoughts about SQ's investments in India, as well as some of the other near-term risks that potentially might surface as a result of the oil crisis that we're seeing at this moment. Eric, hi, welcome to the show. Eric, my first question is for SQ. Is demand actually holding up?
Yes, Singhal. Demand for air travel remain robust, according to the latest set of results. In fact, SIA and Scoot carried a record 42.4 million passengers in FY26, up 7.7% year-on-year. As a result, group passenger load factor rose 1.1 percentage point to almost 88%, as traffic growth of 4.7% outpaced capacity expansion of 3.4%. And this resulted in higher passenger yield of 10.4 cents per revenue passenger kilometers, which was improved 1% to year-on-year.
Okay, all right. Now, before we get to India, let's also talk about the jet fuel situation that all airlines are facing at this moment. In your opinion, question number one is jet fuel supply actually stable in the near to medium term?
We think that Asian carriers like SIA could potentially face some near-term jet fuel supply disruption amid the current Iran war. The shortage was also driven by reduced refinery output in the Middle East, as well as delayed cargo shipment due to the Red Sea rerouting. SIA said that it will try to optimize its flight path and continue to adjust its network in response to demand accordingly. And on the jet fuel costs, we know that the SIA and Scoot has raised airfares across their network, but the adjustment will not fully offset the rise in the price of jet fuels. and we expect the full impact of the higher jet fuel price to feed through in this next set of FY27 results. And as a result, we have lowered our earnings forecast for SIA by 10 to 17%.
Okay, as a sub question to fuel, can you also comment if SQ typically hedges its oil fuel supply and what percentage of that inventory is hedged?
Yes, SIA typically does hedge its jet fuel. Currently, we understand that about 40% of its fuel requirements has been hedged. So we expect to see more negative impact in probably in the second half of FY27.
Okay, all right, great. Now, coming back to India. Now, from what we've read so far, despite Air India making about 940 million Sing dollars in terms of losses for last year, it seems like SQ is dead fast committed to its investments in Air India and sees it as a long game. What are the immediate risks which might affect SQ's core business because of this investment?
Yeah, as you pointed out, SIA continue to face challenges tied to its 25% stake investment in Air India, which is also grappling with industry-wide supply chain constraint, airspace restriction, as well as operation on its key Middle East markets. And in addition, Air India is now searching for a new CEO after its former CEO Campbell Wilson resigned in April. But having said that, I think SIA has mentioned that it will continue to work closely with its partner Tata Sons to support Air India multi-year transformation program. And he also added that Air India has been making some progress in its fleet renewal and aircraft retrofit program. And this will help to improve the end-to-end customer's experience and improve its operational performance going forward.
Okay, great. Eric, and one last point on SQ. What is the company's forward dividend yield outlook to you?
Okay, in the last FY26, SIA declared a higher than expected final dividends of 22 cents as well as a second tranche special dividend of 7 cents. So this bring total dividends per share to 37 cents for the full year. And going forward, we think that SIA is likely to distribute higher than its historical 50% payout ratio. And we are looking at 28 cents for FY27 and 30 cents for FY28. So this will translate to about decent yield of about 5%.
Wow, okay. So at least this appears to be an initiative that could actually stabilize the share price in the near term.
Right. Yes.
Okay.
Yes.
All right. Great. Thanks. Thank you so much, Eric, for your time
Thank you,
on
Singapore.
Singapore Airlines. For our last topic, we want to talk about the semicon-related industry in Singapore. And to share on this, we did a pre-recording with our analyst, Jarek, over the weekend on AEM and UEM as he's currently traveling. So without further ado, let us run the video clip right now.
Yes.
Well, Jarek, thanks very much for taking the call on a Sunday. First, we would like to find out what is driving AEM's phenomenal growth. Help us understand the first Q26 earnings and the new test cell solutions business, please.
Sure, Singapore. So basically, I think AEM has two customers ramping up. One is actually AMD, which is their new customer. And then the next is the old customer, Intel, which is also sort of accelerating growth as compared to a slowdown in growth previously. So in 1Q26, revenue actually rose 35.8% to 116.9 million. But this is on the back of the lower margin contract manufacturing segment actually declining 15.7 year on year, resulting in a more favorable mix. Basically, the test sales revenue, solutions revenue grew actually significantly, and the net margins actually improved from 3.9% to 12.3%, rising sharply both Q on Q and year on year.
Okay, all right. In your report, you also wrote about AEM's customer acquisition strategy going forward. This is going to be very important because it will support its valuation. Could you elaborate what this, what the company's acquisition strategy is going to be?
Sure. So I think AEM is trying to be one of the main competitors in the testing space and is trying to get more clients. So, previously it was Intel, and then this year AMD is ramping up. Next year it'll be Micron who's going to ramp up, and they have also signed a strategic partnership with ASE the Taiwanese listed company, which could actually open up additional revenue streams and opportunities because ASE serve a number of chips or semicon customers out of AEM's reach, like NVIDIA and so on. And then next, they are also in talks with the memory guys in Korea, which rumored to be either HK Hynix or Samsung. And if they could actually grow or gain more customers, basically each revenue stream could represent 100 to 200 million of revenue, right, which could actually potentially bring AEM to the next level.
Okay. As a follow-up question, who are its main competitors for customers like that?
Like Avantes, I think Avantes would be considered its main competitor.
Okay, all right.
Yep.
Well, let's talk about UEM next, which is a precision engineering firm for semicon equipment makers. First Q26 results was also similarly very strong and appear to be related to a new customer. What can you tell us about this customer's strategic importance to UEM?
Sure. So for UMS, basically, if you look at it, last time they have one customer for a very long time, which is Applied Materials. And then 2, 3 years ago, they secured a new customer, which is Lam Research, AMAT's competitor. So what they did was they actually separately expanded their production and built a new factory for Lam Research. And I think last year they started ramping up, but they had some manpower issues as well as ramping up issues. This year, it shows in the revenue that, the ramping up has continued. And I think they have solved some teething issues and managed to ramp up in volume. And we expect actually better quarters ahead as they continue to ramp up. So basically, previously there's one large customer. Now you have another similar size customer. So basically, we expect revenue. Previously, AMAT was giving about 300 million revenue to US. This could potentially double in 2 to 3 years if LAM continue to ramp up at the same speed. So it's going to be like a 1+1 or 1+1 or 1+0.5 going forward for UMS in terms of revenue size and profitability.
Okay, all right. So both these stocks have run up very strongly year to date. How should investors make sense of their valuation against the aggressive growth targets or the growth outlook that you just put forth?
So I think this is the long-awaited semicon ramp-up boom, and this is actually mostly carried by the AI investment that most of the big caps or even China and US they are putting into. And the capex spending has actually resulted in all this AI boom or rather semicon boom that's happening right now. So in terms of valuations, I think investors now are looking either 1 year or 2 years ahead to justify the valuation. And I think because this cycle could be potentially 2 to 3 years or even 4 years. So basically investors are looking, you have to look ahead at least for that time frame. But the key thing to note is also that the AI spending can it actually be sustainable. So one thing to also know is that, all this Google, your Meta continue to see whether their AI revenue can continue to go up and grow fast to justify its capex spend, and whether there's any slowdown in capex spending, which will actually slow down the whole supply chain. So I think this is one of the key risks there, and investors should really keep close watch. If the AI spending and AI revenue generated is continue to go up rapidly, then this cycle should be able to continue. If not, then there should likely be a slowdown going forward.
Okay, all right. Thank you very much for those insights and how true it is. We shall not hold you up any longer, Jarek. Enjoy Thailand and safe travels.
Thanks, Engel. Thank you.
So we've come to the end of today's program. We close the show with many thanks to our panelists and especially our clients for your business. As a reminder, the full research publications on the companies covered today are available on Maybank Trade mobile app and also through your sales representative. So do not hesitate in reaching out to them. We'll also, again, as I said, be sharing the YouTube video link later through them. So until next Monday, stay ahead and trade smart. Thank you very much.